Silver price update, February 22nd, 2026. Why prices just stabilized after massive volatilities. If you've been watching silver over the past few weeks, you already know this has been one of the wildest rides the precious metals market has ever seen. We're talking about a metal that touched over $100 an ounce in late January, then she'd nearly half its value in a matter of days, and is now sitting in the high 70s to low 80s range, slowly trying to find its footing. So today, we're going to break down exactly what happened. What's happening right now as of February 22nd, 2026, and what the forces are that finally brought some calm back to the market, at least for the moment. Let's start with the numbers, because the numbers tell a story that almost nobody would have believed 12 months ago. A year ago, silver was trading at roughly $30 per ounce. As of February 19th, 2026, silver was priced at around $78 per ounce. That means even after one of the most brutal corrections in recent memory, silver is still up well over 150% year over year. That's not a small move. That's a structural shift in how this market is being valued, and it's important to understand what drove it there and what pulled it back. Going into late January, silver was on a historic run. The metal breached the psychologically significant $100 mark for the first time ever, which caused a frenzy of media coverage, retail excitement, and speculative positioning. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, briefly fell below 50, a level not seen since 2012. That tells you how aggressively silver was outperforming its more famous counterpart. But then something shifted, and the sell-off that followed was historic in its own right. Reports from early February described silver dropping roughly 30% in a single session. Think about that. In one trading day, silver erased nearly a third of its value. U.S. Treasury Secretary Scott Bessent publicly attributed the extreme swings to speculative activity, particularly noting heavy involvement from Chinese traders who had built up leveraged positions during the rally. When those positions unwound, they unwound fast, and the market felt every bit of it. So why are prices stabilizing now? There are several overlapping reasons, and none of them exist in isolation. The first is simple exhaustion of the speculative unwind. The traders who were going to sell already sold. Margin calls have largely been met. The froth has been cleared. What remains in the market right now is a combination of longer-term holders, industrial buyers, and cautious new entrants who see the dip as a potential reset point, though that's an observation, not a recommendation. The second reason for stabilization has to do with macroeconomic data. In mid-February, U.S. retail sales data came in weaker than expected, and GDP control group figures fell slightly, signaling a softening in consumer activity. That kind of data tends to shift expectations toward easier Federal Reserve policy, and when the market prices in potential rate cuts, non-yielding assets like silver tend to find a floor. Right now, markets are pricing in roughly 60 basis points of Fed easing by the end of the year. That backdrop has been quietly supportive for metals, even as the speculative chaos settled. The third factor is safe haven demand. There's been a notable rotation away from dollar-denominated assets, as investors weigh ongoing policy uncertainty coming out of Washington. That uncertainty, whether it's related to trade policy, tariff structures, or broader geopolitical tensions, has kept demand alive for precious metals as a hedge. Silver has been a beneficiary of that sentiment, even if it's playing second fiddle to gold's more consistent safe haven reputation. Now let's talk about the physical market, because what happened there was just as dramatic as the price action itself. When silver was in free fall, dealers widened their spreads significantly, or in some cases paused buying altogether. The reason wasn't greed, it was the settlement lag. When a dealer buys physical silver, there's typically a 48 to 72-hour window before that metal reaches a refinery. If spot prices are crashing during that window, dealers can absorb enormous losses. So many of them pulled back their bids, sometimes pricing $10 to $12 per ounce below spot for common silver rounds. That's a detail that a lot of people who were rushing to sell physical silver learned the hard way. The physical market is also dealing with a supply story that hasn't changed just because prices corrected. According to the Silver Institute's February 2026 report, the silver market is expected to remain in deficit for a sixth consecutive year in 2026. Total supply continues to fall short of demand, mining output hasn't meaningfully caught up, and industrial consumption keeps climbing, driven by data centers, artificial intelligence infrastructure, electric vehicles, and the broader energy transition. Solar panels alone use silver in their photovoltaic cells, and global solar installations are not slowing down. JP Morgan's 2026 outlook has silver averaging around $81 per ounce for the year. A Reuters analyst poll puts the median forecast near $79.50. These aren't predictions to act on. They're reference points, showing how analysts are contextualizing where silver sits relative to its fundamentals. What's worth watching going into the remainder of February and into March is the delayed U.S. jobs report and upcoming inflation data. Those two releases will heavily influence how the Fed signals its next move, and silver will react accordingly. A softer labor market or easing inflation could reinforce the case for rate cuts, which historically tends to support precious metals. A stronger than expected reading could reignite dollar strength and put renewed downward pressure on silver. The key takeaway from everything we've seen over the past 3 weeks is that silver remains what it has always been, a smaller, more volatile market than gold. Its market size is roughly 1/10 that of gold, and its futures open interest is about 1/5. That means smaller flows move prices more dramatically in both directions. The January spike and the February crash are both reflections of that structural reality, not anomalies. Right now, silver is in a consolidation phase. The speculative excess has been purged. The supply deficit remains. Whether that consolidation holds or breaks again will depend on the data ahead. And that's exactly what we'll keep watching. Thanks for staying with us through one of the most remarkable stretches in silver market history. Stay informed, stay patient, and we'll see you in the next update.